Welcome to today's episode where we're going to be talking about a critical strategy that just majority of firms don't implement, which is actually reviewing your clients on a regular basis for a profitability and a check to make sure that they are the right types of clients that your firm should be servicing. Whenever we bring on new clients within our coaching business, the first project that we do with all clients is a full review of your client base. And the reality of why is that 99% of firms have not done this for anywhere between 2 and 20 years. This is something that I truly believe needs to be done on an annual basis, if not more regularly. And we should be tracking and reviewing our client base at least as part of every quarter as part of our quarterly planning. So why is it actually even important that we review the clients that we currently serve? And the reality around why this is so critical is we need to ensure that we are serving our clients at the highest level, that we're providing them with all products and services that they require, not just that they know about, but ultimately that they do require from us. And ultimately that we are ensuring that our relationships are profitable. And this is one of the amazing things that when we do this review and we have a process that we walk through clients with around this, is that the majority of time there is always clients that are a surprise that are either more profitable than we thought or significantly less profitable and we need to change. So we run a 3-step process around being able to do a review of your clients. So once we do a full review of the client base, we basically put people into 3 buckets. Clients that are ideal clients that are buying all products and services that they need, and they are profitable, and our average hourly rate that we're getting for these clients is exactly where we need it to be. So that is one bucket of clients that you will have once you do the review that are ideal. We just need to continue to serve them and adding value to them. The second bucket that we put people into is these are non-ideal clients. They're either not in the niche that we serve anymore, their average fees are well below, and they only want things like an individual tax return, and we only deal with business clients now. So these are really non-ideal clients that we need to set their futures free. So there's a couple of ways we can set their future free depending on how many there are. We can sell a chunk of our client base if we have enough of them. Or if there's only a small amount, then you can find another accounting firm to be able to refer them to that can serve them in a more meaningful way for where they're at in their journey. And this is really the key with any firm that is $1 million plus or just under. Doing this review, you'll have at least 10 to 20% of your client base that you're going to need to help them find a more suitable accountant or bookkeeper for them in the future. And the easiest way is to just sell off chunks of your client base. And this is not something that you'll do once, you'll do it regularly. But these are the clients that no longer you can serve at the highest level because your firm has evolved and grown beyond the services that they require and the value that you can add to them. So that's an easy bucket to move on. You've then got this third bucket, which are really what I call the potentials. They're not ideal clients at the moment because they're not buying all the products and services that they require. Their average hourly rate is okay, but it's not exceptional. But they're not non-ideal that you want to get rid of them because they still have the potential. So these potentials, we need to either increase them to become ideal clients or we need to move them into the bucket of non-ideal and then we exit them from the firm in future years. So this doesn't need to happen on day one, but you need to do one of 3 things. So the first step to be able to identify and do the analysis of your client base is we want you just to put these into a spreadsheet with the first column really is the key, which is the average revenue per client. We want you to then scale that from your largest client with the highest average fee right down to the least or the smallest average client group fee. The second bucket we want to put this into then is what is the average hourly rate for that client? So ideally you will track time and ideally you'll be able to attribute how much time you are spending on this client. If you don't track time, the analysis becomes a lot more subjective as to factual. But if you do track time and the average fee is, for example, $10,000 and you spend 10 hours on it, then the average hourly rate for that client is $1,000. So that is the first analysis we want to do once we know what the average group revenue is per client. So do that analysis in those extra two columns. So how much time you're spending for each client. And then the third one is the average hourly rate. What I then want you to do is then put from the highest average hourly rate to the lowest, the client base. So when you're sorting it that way, it's going to be quite interesting, because what you'll find is, although you have large clients and the 80-20 rule is always applicable, what you will find is that they are not always the most profitable. What we typically find with the firms that we've done this analysis on is that they give those clients a lot of free or extra things, and there's all this scope creep that comes into it. So by identifying by the average hourly rate the profitability per client, that is the true measure. The revenue you get per client is a vanity metrics in a lot of ways. The average hourly rate, meaning the profitability per client, is the key number to do the analysis. Once you've got that average hourly rate, that's when you can sort through and put them into, are they an ideal client? Are they a potential? Or are they not a right fit for our firm anymore? So when we talk about the potentials, you may have some of your highest fee-paying clients sitting in the potential mark because they're not paying you appropriately for the services that you're providing to them. Their average hourly rate may be significantly lower, or even 15, 20% lower than what your ideal clients are. So really identifying what the target average hourly rate is will then be able to enable you to go, are they a potential, or are they ideal, or are they we no longer serve these clients to the highest level? So once we've done that, the next analysis we want to break down is we want to go into what are all the products and services that your firm provides to clients, and what is the profitability per product or service. We often see a lot of firms that have, it could be a really strong average revenue per client, but the services they're providing, like bookkeeping, for example, you're going to have a lower profitability, meaning a lower average hourly rate on these. So what we want to understand is what is the mix of products and services that clients have that will get you the highest profitability per client and ultimately add the most value to your clients. So once we start to break down again all of the different services that you provide to clients, we want to understand what the service is. And in this case, it could be tax. How many hours did that work take? And then what was the revenue that you generated for that piece of work? And then what's the average hourly rate for that product? So what we're able to identify then is the profitability or the average hourly rate per product. And then you can sort that for all clients and see, are we undercharging some clients in some cases? For example, we had one firm that was spending 50% more time on some of their bookkeeping clients. So the average hourly rate was significantly lower than what it should have been. And it was only through this analysis that this was picked up. So this is a great tool to be able to actually do a full review of your client base and not only see who are the most profitable clients for you, but what are the most profitable services and products that you provide to these clients. And one of the key things that's going to come out of this is that you will identify that for a majority of your clients, you are not offering many products or services. They're only buying a couple of the key ones that they came into you for, but they're not buying everything that they ultimately need. So this is a great opportunity for you to identify where you can add more value to your clients. But what this analysis will really do is show you very clearly which clients are paying you appropriately and are profitable based on an average hourly rate, and which clients are underpriced, which you need to realign. So the strategies to implement for the potentials where the average hourly rate is lower than what it needs to be, the opportunity to fix this is a couple of ways. One is to become more efficient with your process and systems, which will drive the average hourly rate up and ultimately the profitability per client. But if we're assuming that the process is the same for all clients and efficiency is not currently the problem, then it's a pricing issue, meaning you've either priced the job wrong or it's taking too long. But if we've taken out the process part of it and it is a pricing issue, it means that we can realign the pricing so that you're getting the average hourly rate and the profitability per client to be consistent across all clients. And that is one of the wonderful things that come out of this review of your client base is you're going to really see it for probably the first time in a long time, the clients that are actually the most profitable, not the ones that pay you the most. And that is what most firm owners get wrong, is they think the ones paying us the most are the ones that are actually the most profitable when they're not. This really highlights scope creep, because you're starting to really see the average hourly rate per client, and it allows you to then implement other strategies, which we'll be talking about in other podcast episodes, that can actually make you more efficient and drive this average hourly rate up. But for the client analysis, which is what we're talking about today, the key takeaways that I want you to really focus on are around doing the due diligence on who you currently serve, the profitability per client and per product and service that you offer them. And then the thing that comes out of the back of that is you'll be able to identify where you're not serving your clients to the full extent that they need from you, which is, are they buying all products and services from you that they need? Now, clients won't come and ask for these products and services. It's up to us to be able to offer these and show the value of why they need them. So for a lot of clients, you'll probably find that you're not offering many. It might be 2 or 3 products or services you're offering to clients, and that's perfectly okay for now. But that is the wonderful opportunity that you'll have to be able to grow and expand your client base without having to actually attract new clients, is just add more value to existing ones. Going through this exercise, you're going to have to make some tough decisions. You're going to have to let go of clients that may have been clients and what I call legacy clients for a long period of time that you've served for a long period of time. And they're great people. But we need to take the emotion out and go, we cannot serve our clients at the highest level if we're serving other clients that are non-ideal clients. And that is one of the key things, is that your non-ideal clients are actually taking you away from the people that you can serve and add the most value to. So by keeping them, you're actually doing a disservice to the clients that you should be adding the most value to. So yes, it's difficult. Yes, they've been clients for a long period of time, but as long as you do it respectfully, and this is the key point that I say to all of my coaching clients, as long as we're respectful and we treat our clients in a humane way and we're empathetic and we find them a better home that's more suited to them, the clients will actually respect you for that decision as opposed to be disgruntled with you, because they're going to probably, realistically, the person that you send them to or sell them to is going to serve them in a more meaningful way that you are, because for that accounting firm, they're actually an ideal client. They're exactly what they want to deal with on a day-to-day basis. But for you, they're not. So they're going to get a higher level of service and they're going to be better served by being with someone else than they are with you. So, with anything, hard decisions need to be made. But if you do this process once, if you then get the data clean, you can then get it into dashboards, and you should be regularly reviewing this data. Every quarter, we should be looking at who are the fastest growing clients, which clients of ours are declining in their services that we're providing them, and which clients have not changed at all. Which clients need more products and services because they just don't have all of the things that they need to really be able to grow and thrive and survive in their businesses, because we're not providing all those services to them. If you do this every quarter, you will never be looking for work. You will always be able to add more value to your clients. You can still take on new clients, but it is an amazing place where you can serve your clients at the highest level. You can be rewarded by having profitable clients, and ultimately your bottom line will thank you, meaning you're going to be more profitable so that you can reinvest that money back into your team and to the business to continue to grow a thriving and surviving firm that really adds the most value to clients. So while this is not easy, every year you need to do it. Every quarter you need to review it. It's a tactic that the most successful firms do and everyone else doesn't. That's another tactic for this week.